Chapter 2, Filing Status. The following forms and publications are used in the research and development of this lesson. Forms and publications are available at www.irs.gov. The objectives of this chapter are to identify the 5 filing statuses and the requirements for each. Know when a return needs to be filed. What are the requirements to be a dependent? What are the tiebreaker rules for dependents? The difference between custodial and non-custodial parent. What are the requirements for a taxpayer to claim a qualifying child or relative? Know the difference between a qualifying dependent and a qualifying relative. Identify the 5 tests for a qualifying child. Identify when and who must file a decedent return. Understand what is the Presidential Election Campaign Fund. And finally, what is an exemption? Now, a filing status may seem to be a very simple determination, yet there are so many different situations that it could be very detailed. How the taxpayer is determined to file their return can impact whether they qualify for certain credits or adjustments. Many clients will come into your center and sit with you, and there will be a husband and a wife, but they wish to file separately. Now, when they say separately, what they're asking for is one to be head of household with the kids and another one to file single. The advantage, as they have discovered from others or themselves, is a higher amount of combined standard deduction, and depending on income amounts, could qualify one or the other for special credits such as earned income credit. As opposed to filing together, married filing joint, they would not qualify. Their income would be too high. It is your challenge as a tax preparer to let them know what is legally their options and not what they are wanting or choosing to file. The 5 federal filing statuses are single, married filing joint, married filing separate, head of household, and qualifying widower with dependent child. Now, single, and actually almost all of the filing statuses, is based on their classification or their status on the last day of the year. And so also with single. It's also, they could be unmarried or legally separated by divorce or separate maintenance decree, and essentially just does not qualify for any other filing status. Most married people, and that is defined federally as the union between one man and one woman. And on a federal level, that is the only allowable definition. Both are married, and the spouses are filing a joint return, even if one had no income or deductions. I'm surprised the number of times that when there is only one income, then the thought is the other spouse would be put as a dependent. And it takes some explaining on our end to let them know, no, that you still file both as taxpayers, one the primary taxpayer, the next one a secondary taxpayer. Now, there is no requirement for order on that. In other words, if it's the wife who is claimed first and who puts her name first as primary taxpayer, there's no problem with that. There's certainly no idea that you must place the man first. The issue becomes more of consistency, and if whichever spouse is put on the first line as primary taxpayer, to continue that year in, year out. Another option is if they're living together in a common law marriage that is recognized in the state, and you would have to know your particular state laws to understand. They could also be married and living apart but not legally separated under a decree of divorce or separate maintenance. If one of the spouses died during the tax year and the taxpayer did not remarry before the end of the year, then you would, that first year, in the year of death, you would still file as married filing joint. And we will look later at the other options. If the spouse died during the tax year and the taxpayer remarried before the end of the tax year, they may file married filing joint with the new spouse. The deceased spouse must file a tax return, and the filing status is married filing separate for the tax year. Married filing separate is not a very, not even popular, but just not a good option for many people. Taxpayers may choose this status if they are married, living together, or apart. Taxpayer wants to be responsible for only their tax liability. Many times a married couple will choose married filing separate because of a back debt, either taxes or child support or student loans, defaulted student loans, and the other spouse does not want to take on or have their refund pay for those debts. Problem with that is the taxpayer in choosing this status, it may result in less tax than they would owe on a joint return, but the taxpayers who consider married filing separately should also understand that there are severe limitations in deductions, adjustments, and credits. So it's possible that it would really reduce their refund if they file married filing separate, and the benefits could far outweigh the negative consequences. Head of household, I believe, is the most abused tax filing status that there is. But if on the last day of the tax year, the taxpayer is unmarried or considered unmarried, and that means they are filing separately from the spouse did not live in the home at all during the last 6 months of the tax year, and for more than 6 months, the home was the principal residence of a qualifying person. However, dependent parents do not have to live with taxpayer. Paid more than half the cost of keeping up a home for the tax year, the home was, for more than half the year, the main home of a qualifying child, stepchild, adopted child, or relative who can be claimed as a dependent. Also, foster child requirement is actually 1 full year. So you can't be head of household and be the only one, being the single person living in a home. There must be a dependent qualifying person, whether it be a child or relative, that you are supporting. Taxpayer can still meet this test if the taxpayer cannot claim their child as a dependent only because the taxpayer stated in writing to the non-custodial parent that he or she may claim an exemption for the child, or the non-custodial parent must provide at least $600 support for the dependent and claim an exemption for the dependent under a pre-1985 divorce or separation agreement. Qualifying widow or widower with dependent child. Now, this one applies for when a spouse dies in a particular year, leaving the other spouse with dependent children at home, and the other spouse does not remarry. They were entitled to file a joint return with the spouse for the tax year in which the spouse died, whether or not the taxpayer actually filed a joint return. That allows them, and the advantage is then they would have the greater amount of standard deduction and the lower tax rate of married. Also, they must not have remarried by the end of the year. And they must have a child who qualifies as the taxpayer's dependent for the tax year, and they paid more than half the cost of keeping up a home that was the main home for the taxpayer and that child for the entire year. And the advantage is then they can continue to receive the greater standard deduction of married filing joint for 2 years. So the year that the spouse passed away, they can file married filing joint, provided they don't get remarried and they do have dependent children at home. Then the next 2 years they can fall under, with the same restrictions, can fall under the qualifying widow or widower with, as long as there are dependent children. That gives them the same standard deduction as married and the lower tax rate. It's only past those 2 years going into a third year, again provided they've not remarried and they still have dependent children, then it would switch to head of household. Another very important point is the Social Security number must be listed correctly on the tax return. It is advisable, when at all possible, to seek the Social Security card of your clients. In many cases, I find that they don't have their Social Security card with them, which is and now we advise people don't carry it. Also, it's possible they've lost it and never replaced it. So advise them to go get another one. You can still do the Social Security number, the tax return with the Social Security number that they provide, but advise them of the issue that it must match, the name and the number must match the records under Social Security Administration. An exemption reduces your taxable income, and most taxpayers are entitled to deduct a standard amount from their income before computing their tax liability. Exemptions may generally be claimed for the taxpayer himself, the spouse, and qualifying dependents. Qualifying is a very important word when it comes to tax preparation. The taxpayer is allowed one exemption for each person claimed on the tax return. The taxpayer can claim an exemption for a dependent even if the dependent files a return. The taxpayer can claim an exemption for a qualifying relative only if the following three tests are met: the dependent taxpayer test, the joint return test, and citizen or resident test. Now, if the dependent cannot engage in any substantial gainful activity because of a physical or mental condition, and if a doctor determines the condition has lasted or can be expected to last continuously for at least a year or can lead to death, this would allow, under tax law, to be able to continue to claim the dependent as your dependent, and you can qualify for most applicable credits. Very important to keep that in mind. It must be something a doctor has determined and not you choosing to determine, and you must still provide more than 50% of their support. Now, what is a qualifying child? There are 5 tests that must be met for a child to be the taxpayer's qualifying child. And the 5 tests are, and these are in order of priority: relationship, age, residency, support, special test for qualifying child of more than one person. Now, when you get clients in your home, and I have seen several in my experience, where generally speaking, it's the husband who's mad because he can't claim his child support for the sake of being able to claim the child as a dependent. And many of them will argue, well, I pay child support and I pay more child support than she does, and therefore I should be able to claim them. My first question to this person is, who did the child live with? You'll notice in these tests that residency is a higher priority than support. When they answer, well, they live with the wife, they live with the mom, that's where I can come in and explain that qualifier. Support is a lower priority than residency. If the child lives, if all other tests apply, and the child lives with the mom for the full year, she has the right to claim the child, even if the support isn't equal. Now, children of divorced or separated parents. Generally, a child will be treated as the qualifying child of the custodial parent. And that's the key, even with the 5 tests that we spoke of a minute ago. A child could be treated as a qualifying child of a non-custodial parent if all of the following apply. 1, the parents are either divorced or legally separated under a decree of divorce or separate maintenance, and are separated under a written separation agreement, or lived apart at all times during the last 6 months of the year. The child received over half of the support for the year from the parents. The child is in the custody of one or both parents for more than half of the year, and either of the following is true. The custodial parent signs Form 8332 that the custodial parent will not claim the exemption for the current year, and the non-custodial parent may claim the exemption. And this is a very important form to fill out because that's usually the issue. There's a lot of argument over who can claim the exemption. A decree of divorce or separate maintenance or written separation agreement that applies to 2012 provides that the non-custodial parent can claim the child as a dependent, and in the case of a pre-1985 agreement, the non-custodial parent provides at least $600 for the support of the child during the year, or the custodial parent signs a written declaration that he will not claim the child as a dependent for the year. As everyone understands, or they need to, only one person can claim that exemption and claim a child as a dependent. It cannot be split. Here's Form 8332, that is releasing the claim to exemption for child by the custodial parent. And many times when we speak to clients like this, they switch off. It could be a court decree. It may be just a simple understanding and agreement between the parents that one will claim 1 year and the other one claim the next. Continuing on here, Form 8332, release of claim to exemption for future years or revocation of release of claim to exemption for years. Now, there are tie-breaking rules simply because the 5 tests that we spoke of earlier, if all the tests are equal, therefore, as an example, both people wanting to claim the dependent are the parents. That's the highest priority, is relationship. So if a parent and a grandparent are fighting over that, the parent has the greater right to claim that child as a dependent than the grandparent, strictly by relationship. So only one person, but if only one person is the child's parent, or if 2 of the persons are parents of the child and they do not file a joint return together, or 2 of the persons are parents of the child, they do not file a joint return together, and the child lived with each parent the same amount of time. So you're going down the list of priorities of the 5 rules for claiming a child as a dependent, qualifying child. So as each one equals the same amount, and even with whoever they lived with the most doesn't count, then you have to go to tiebreaker rules. Also, there is the tiebreaker rule of that none of the persons are the child's parent. Then the child will be treated as the qualifying child of the, so if it's only the first priority, which is relationship, obviously the parent wins the tiebreaker rule. If it's the next one down, whoever they lived with the longest, that matters. If that one is equal, then it's the parent with the highest adjusted gross income. So bottom line, support, if everything else above is equal, then under support, it's whoever makes the most money. And if, again, there are no parents involved, then it's the person with the highest adjusted gross income, or AGI. Now, it can be down to who supports them. And one of the qualifiers as a dependent is you must be able to provide support, over 50% of the support. What does that look like? Well, cost of maintaining a household. It includes upkeep expenses such as rent, mortgage interest payments, repairs, real estate taxes, insurance on the home, utilities, repairs, and food eaten in the home. It does not include clothing, education, medical treatment, vacations, life insurance, and rental value of the home or transportation. I had a client with a daughter going to college, and there was an issue over who gets to claim her exemption, and in that case also education credits, and the daughter was getting a little upset that the mother was demanding to be able to claim the exemption and, of course, then the earned income credit and the education credits. So I simply asked the daughter, well, okay, let's look. You work, you make your own money. Let's see if it's to your benefit and if you have the right to claim that. Do you pay rent? And her answer was no. Well, do you pay for the utilities? No. How about food eaten in the home? And I'm sure that's probably most of the time. Yes, you may go out with your friends. Well, by the end of the questioning, the daughter came to see what we were getting at, since the mother provides most of the cost of maintaining the household where the daughter lives, she finally understood why she didn't have the right to claim the exemption, but the mother did. So a nice easy chart to use is something like this: cost of maintaining a household. This is what the IRS would require should they want to have you verify that you do provide more than 50% of the support for the child. So here's a breakdown. This chart will show primarily anything and everything that you might be paying for toward a household, and then of course amount paid by the taxpayer versus amount paid by others, and the total cost to come up to make sure that it's more than half of the cost. Now, next let's look at standard deduction. Standard deduction is based on filing status. So as we spoke earlier about the challenges of determining the correct filing status for individuals, this is primarily why there is an issue at it. Single filing status gives you a standard deduction of $5,950. And we know that deductions lower your taxable income. And you will see that as we go through the lessons here. So the more standard deduction, obviously, the lower the taxable income for an individual. Married filing joint or qualifying widower with dependent child is double that of single, $11,900. Married filing separate is the same as single, $5,950. Head of household, which means usually one parent with children, has a higher standard deduction because obviously they can't share the cost of the household with another parent or another adult in general. So head of household does give you a larger amount than single, but not as much as married, and that standard deduction is $8,700. So you can imagine why people would like to, being married, would rather file separately, meaning one of them filing single and another one filing head of household with the kids, because those two combined is greater than the $11,900 standard deduction of married filing joint. Now here's a nice chart that shows you the filing requirements for 2012. I will get periodically someone coming in asking, do I even need to file? And usually I will ask, may I see your W-2? And I look at the W-2 and I'm going to determine here whether they have to file. For instance, if you're single and under 65 at the end of 2012 and your W-2 showed less than $9,750, then you don't need to file. If you can imagine it this way, $9,750 is your standard deduction and your personal exemption combined. So your income would have to be greater. If your income was $9,750 exactly, then you'd have minus that equal amount of deduction to arrive at zero taxable income. Therefore, there's no tax. No need to file. There are a couple of other reasons to file. If under the W-2 you see where there is federal tax withheld, then the advantage of filing is to receive that refunded back to you. Also, if they qualify for credits, especially refundable credits is the one that they would qualify for, then it's still to their advantage to file a tax return. But these are the minimum requirements of earned income in which the person has to file or should file or doesn't have to file. So for example, married filing joint and both spouses are 65 or older, that is the highest amount of income that a person would have to file a tax return, and that's $21,800. So that's standard deduction of married filing joint plus the additional standard deduction for being over 65 plus 2 exemptions because there's husband and spouse, and therefore they would have to have combined income of greater than $21,800 before they would have to file. So in many cases, when you have a client who lives totally on Social Security, or has been disabled all year, it's possible they may not have to file because there is no taxable income involved in those benefits. The Presidential Election Fund was set up to help pay for presidential election campaigns. If the taxpayer has a tax liability of at least $3, she or he may have $3 of the tax liability go to this fund by checking the Yes box on Form 1040, 1040A, or 1040EZ. Now, a lot of clients are confused by this. They're saying, am I paying an extra $3, or are they taking an extra $3 away from my refund? And the answer is no. The issue is you are, by electing this, choosing for $3 that would normally go toward the general fund to have it marked to actually go into the presidential election fund, and that is it. So it's not any additional monies you have to pay out. You're just designating $3 of the general fund over to the presidential election fund. If the taxpayer is filing a joint return and they have at least $6 of tax liability, the taxpayer's spouse may also have $3 go towards the fund. By checking yes, the taxpayer's tax or refund does not change. That concludes Chapter 2. I encourage you to go to Chapter 2 review questions online and the TPAs online. You must pass with a 70% or better. If you don't, you're able to retake the review questions and the TPAs until you do pass with a 70% or better. And, of course, read Chapter 3 for next. Thank you.